The first index fund was called Un-American. Brokers printed posters saying so and put them on office walls. It raised a fraction of what it aimed for and was mocked as a folly. Today, the idea manages trillions of dollars. And the reason it was hated is more interesting than the reason it won. Because the objection was not that it would fail. It was that it refused to try. Start with what an investment fund was supposed to do. You hand money to a professional. They research companies. They buy the good ones and avoid the bad ones. And in exchange for that skill, they take a fee every year. That is the entire premise of active management. You're not paying for access to the market. You are paying for selection. In 1951, a Princeton undergraduate wrote a thesis about this. His name was John Bogle, and he studied how mutual funds actually performed. His conclusion was cautious, and it stayed with him for 25 years. Funds, he wrote, could not claim to beat the market averages. By the 1970s, he was running a fund company, and he had been forced out of the firm he had helped lead. What he built next was designed around one uncomfortable observation. The average investor cannot beat the average because they are the average. All the shares in a market are owned by somebody at all times. So collectively, investors earn exactly the market return. Before costs. After costs, collectively, they must earn less than the market. That is not a theory about skill. It is arithmetic. For every manager who beats the index, another must trail it. They are trading with each other, and the fees come out of both. So Bogle proposed something that sounded like surrender. Do not try to pick winners at all. Buy every company in the index, in proportion, and simply hold them. Imploi non analistis. Do almost no trading, and charge a fee so small it barely registers. In 1976, that fund launched. The underwriters hoped to raise $150 million. They raised about 11. It was so far short that they considered canceling the launch. The industry press called it Bogle's folly. The criticism was not mainly technical. It was moral. One competitor said he could not believe investors would settle for merely average returns, which captures the objection perfectly. Accepting the average felt like giving up on ambition. In a country built on the idea of doing better than average, buying everything and hoping for nothing special was close to unpatriotic. Hence the posters. But the objection contained a hidden assumption worth naming. It assumed that trying harder produces better results. In most fields, that is true. Investing is unusual, because everyone trying hard is competing against everyone else trying hard, and they're all paying to do it. It is worth asking what an index actually is, because it is not obvious. The most famous one is the S&P 500. People describe it as simply the 500 largest American companies. That is close, but it is not quite right. There are eligibility rules about profitability, liquidity, and listing. And then a committee decides which companies actually go in. Human beings meeting privately, choosing what the index contains, which means even passive investing delegates selection to somebody. You have not escaped judgment. You have changed who exercises it. And you now pay almost nothing for it instead of 1% a year. Other indexes are purely mechanical, with no committee at all. Total market funds simply hold nearly every listed company available. The difference between those choices is small over long periods. But it is not nothing, and it is rarely explained. Now, the maths that eventually settled the argument. Suppose two investments earn the same 7% a year, gross. One charges you 1% annually. The other charges almost nothing. 1% sounds trivial, and for 1 year it is. The problem is that it is charged every year on the whole balance, including on the growth that the fee itself prevented you earning. Over 40 years, that 1% does not cost you 40%. It costs close to a third of your final balance. Not a third of the fees, a third of the money you would have had. Compounding works in both directions, and almost nobody feels the second one. A 1% fee is invisible on a statement. It is enormous on a lifetime. For years, this was an argument. Then it became measurable. Firms began publishing long-running comparisons of active funds against the plain index they were trying to beat. Over 1 year, plenty of managers win. That is expected. Over 10 years, the majority of them trail the index. Over 20, The proportion that beat it is small, and the ones who did are hard to identify in advance. Past performance genuinely does not predict future performance well, which is why that sentence appears in the small print of every advert. It is not there because lawyers are cautious. It is there because it is true. There is a structural detail here that matters as much as the maths. Bogle set Vanguard up so that the funds own the company, and the investors own the funds. So there are no outside shareholders taking a profit from the fees, which means the firm has no commercial reason to keep costs high. Most fund companies are owned by someone else entirely. Their fees are revenue, and revenue belongs to the owner. That is not a scandal. It is how ordinary companies work, but it explains why fees fell where ownership was arranged differently. Structure does more work than intention, almost always. The change did not happen quickly. It took about 30 years. Through the 80s and 90s, active management stayed dominant. Bull markets make everyone look skilled, and fees feel painless when returns are high. Then came two crashes in under a decade. The dot-com collapse, and in 2008, investors who had paid heavily for expertise watched it fail to protect them. That is when the question changed from, can they beat the market, to what exactly am I paying for? Money moved, and once it started moving, price competition began. Fund companies cut fees to compete, then cut them again. Some index funds now charge nearly zero, and a few charge literally nothing. The product Bogle was mocked for became the industry standard, and by around 2019, more American stock fund money was invested passively than actively for the first time. Now the part that is genuinely unresolved. Index funds do not decide what companies are worth. They buy whatever the market already says is valuable. The work of judging companies is done by active investors. The people index funds do not pay and largely replaced. So a market that was entirely passive would have nobody setting prices, which is a real problem, and economists argue about how close we are. Passive investing overtook active in American stock funds around 2019. Nobody knows the threshold where price discovery genuinely degrades. The honest position is that indexing works partly because others still do not. It is a strategy that benefits from not being universal. That is worth knowing if anyone tells you it has no downside. And it protects you from precisely one thing: cost. It does not protect you from the market falling. An index fund holding everything falls when everything falls. In 2008, it lost roughly what the market lost, which is the point and is also genuinely unpleasant to live through. Low cost is not the same as low risk, and the two get confused constantly. There is a second worry, and it came from Bogle himself. Near the end of his life, he wrote about what his own idea had created. Index funds do not just hold shares. They hold voting rights. Every share carries a vote on how that company is run. And those votes are exercised by the fund manager, not by you. Because indexing concentrated into a small number of very large firms, a handful of companies now vote enormous blocks of American corporate ownership. Bogle warned that this concentration was not healthy. He was not attacking indexing. He invented it and defended it to the end. He was pointing out that a good idea taken to scale becomes a different idea. That is a rare thing for anyone to say about their own work. So look again at what happened in 1976. A man proposed buying everything and doing nothing. He was told it was mediocre, defeatist, and un-American. He was not offering a way to be cleverer than other investors. He was offering a way to stop paying to be clever, which turned out to matter more over a long enough period. The market did not reward the best analysis. It rewarded whoever kept the most of what the market already gave them. That is a strange lesson, and it is why it took decades to accept. Bogle died in 2019, the year passive overtook active. He never became especially rich from it, which surprises people. Because of how he structured the company, there was no stake to sell. The value went to the investors instead by design.